Now, Standard & Poor's has just published its European housing report, and we can take a look at it now with the firm's chief European economist, who joins us live from Paris. Welcome to the Pulse, Jean-Michel Six. If I may start, good morning to you. If I may start by looking at the overall picture. What is your overall take on what's happening in Europe? Do you see us an upturn now?
As far as the housing markets are concerned, yes. Well, clearly the correction that started at the beginning of 2008 was fairly short-lived. If you look at the UK, for instance, prices have been rising again since the beginning of this year, which is quite amazing, really, given that, after all, we've only seen about a 20% decline, peak to trough, after more than 100% rise between 2000 and 2007. So this report is really based, first and foremost, on the observation that this correction in the UK, in France, and in other countries has been fairly short-lived. And so we were wondering whether it was enough to correct all the excess of the previous bubble that we've all witnessed. And
what's your conclusion?
Well, what we came up with is the fact that markets remain overvalued. We looked at price-to-income ratios. We looked at the price-to-rent ratios, key indicators of potential over or undervaluation on those markets. And our conclusion was that in most cases, markets remain overvalued by about 20% for the French market, about 17% for the UK market, a bit less for Spain. The only market, in fact, that now seems undervalued, given that the correction was much more dramatic than anywhere else, is Ireland.
And what about Germany? Is it undervalued or is it still overvalued?
Well, Germany is really the exception to the rule because they did not have a housing bubble in the first place. And so, as a result, prices still look fairly cheap, at least by European standards, maybe not by German standards, but compared to other markets, clearly Germany is still undervalued. But that's really an exception.
Now, if Ireland is the only one who's had a big enough correction, does that mean you anticipate another correction?
Well, that's the big risk. Undoubtedly, there is a risk that when interest rates start to rise again, which we expect in 2011, then indeed we could very well see a second dip in the markets. At the moment, the very low interest rates are very supportive of the housing markets across Europe, in the UK and in continental Europe. Clearly, when interest rates start to rise again, certainly we could very well see a second leg to this correction, which again has not done its job in full. We still have overvalued market from a long-term perspective.
And just very briefly, if you may, what about the glut in housing in Spain? Are we seeing that absorbed yet?
That is going to take an awfully long time. I mean, some local estimates in Spain suggest that at the beginning of 2011, there was over 1 million dwellings of excess supply. That obviously will take several years to be absorbed. We are fairly pessimistic about the Spanish housing markets. We think that whilst price declines have slowed, at the same time, the end of the tunnel is not near at all. Another couple of years of declining or very low prices are in store as far as Spain is concerned.
Jean-Michel Six, thank you very much indeed.